Johnson Outdoor's latest earnings report, well, on the surface, it looked like a home run. So why in the world did the stock absolutely tank in this crazy intraday reversal? In this explainer, we're going to dig into the numbers, peel back the layers, and find out what really spooked the market.
All right, so here's how we're going to crack this case. First, we'll look at the big headline numbers. Then, we'll dive into the market's, well, pretty wild verdict. After that, we'll hear what management had to say. And finally, I'll give you our take on the stock.
Okay, let's start with the numbers. And at first glance, things looked pretty darn good. You can see why people were initially optimistic, especially with the way the company finished the year. And this is where that story really begins. We're talking $135.8 million in Q4 net sales. Now, that's a $30 million jump from the same time last year. I mean, that's a huge increase. It really pointed to a strong finish to the year and a solid beat on what everyone was expecting. But here's where things start to get a little weird. This is our first major clue in the mystery, a full-year net loss of $3.35 per share. Ouch. That is an ugly, ugly number. And trust me, it's a huge piece of the puzzle. We're definitely coming back to this one. But you know, if you look a little deeper, under the hood, things are actually getting better. Check this out. Gross margin is up, and they managed to slash their operating loss by more than $27 million. I mean, that's progress. These are real signs of a company that's tightening the bolts and getting its house in order. So you've got strong sales, you've got operational wins, but the market's reaction? Oh, it was just brutal. So the trading day started off great. The stock popped, jumping up to over $48 a share, and then, bam, the floor just fell out from under it. A massive reversal sent the stock tumbling all the way down, closing almost 13% off its high. All that morning optimism? Poof, gone. And get this wasn't some slow, lazy drift downwards. Nope. Trading volume literally exploded to over 3 times its daily average. That tells you there was real conviction behind the selling. People were rushing for the exits. So that brings us to the million-dollar question, right? You've got strong sales, the operations are improving. What on earth happened to spook the market so badly? To figure that out, we've got to hear what management has to say. All right, so to really get to the bottom in this, we need to understand management's side of the story. They're basically framing this as a reset year, a time to stabilize the business and rebuild for the future. And here's the CEO, Helen Johnson-Leopold, basically describing the year as a tale of two halves. She pointed out that, yeah, things started slow, but then their new products really took off, driving a ton of growth and creating some real momentum heading into the new fiscal year. So what's their playbook? Well, it really boils down to 4 key things. Keep innovating with cool new products, clean up the portfolio by getting rid of stuff that's not working, slash costs to be more efficient, and, this is a big one, maintain a fortress-like balance sheet. And when they say fortress, they are not kidding. The company is sitting on over $176 million in cash and investments, with 0 debt. Absolutely 0. That gives them a ton of flexibility to navigate whatever the market throws at them and keep investing in their strategy. Okay, and here it is, the smoking gun. Remember that huge negative $3.35 loss we talked about? Well, it turns out it was almost entirely due to a weird accounting rule, not because they were bleeding cash. Here's the simplest way to think about it. The company had a bunch of tax coupons it could use to lower its taxes in the future. But because of some recent losses, accounting rules basically forced them to put those coupons in a drawer for now. That move, on paper, is what turned a small loss into a gigantic one. But here's the key. It's a non-cash charge. No money actually left the building. And what's really interesting is that one day they could be allowed to take those coupons back out of the drawer, which would actually create a huge profit boost down the road. So where does all of this leave us? On one side, you've got management's story of a turnaround in progress. And on the other, you've got the market screaming that it's not buying it. Let's weigh the bull and bear cases. The bull case is pretty straightforward, right? The new products seem to be a hit, that balance sheet is an incredible safety net, and that weird tax thing we just talked about could actually turn into a major tailwind for profits later on. But the bears have a point too. The whole outdoor recreation market is still pretty shaky, and investors are just not convinced that the great performance in the second half of the year is going to last. So with all these conflicting signals, we're initiating our coverage with a market perform rating. For the next quarter, we think revenue will probably come in right where people expect, but we're going to be watching those margins like a hawk. We see the stock staying stuck in a range, probably between 40 and $45, as the market just waits for a clearer signal on which way things are heading. So, to put it simply, the company itself seems to be making all the right moves, but the broader economy is like a massive headwind blowing right in their face, and it just makes it too tough to get more bullish right now. And that leaves us with a final question, the big one. Is Johnson Outdoors a coiled spring, just waiting to pop on the first bit of good news? Or is it a classic value trap? A company that looks cheap but is just stuck in the mud of a really tough consumer market? We'll have to wait and see. And as always, please remember, this is not financial advice.